SanDisk just reported a 78.4% gross margin, signaling a massive transformation that should immediately change your stock market analysis of the semiconductor sector. When you see a jump like this, a staggering 55.9 percentage point leap from the 22.5% reported just 1 year ago. You have to realize this is no longer a standard hardware company. Margins of this magnitude suggest SanDisk is no longer just selling plastic and silicon. To put that in perspective, they had an operating loss of $1,881 million only 12 months ago. This is a classic example of operating leverage, where profits grow much faster than revenue because fixed costs stay relatively stable. However, the trade implication of this growth becomes more complex once you look at the quality of earnings and the underlying cash movements. Revenue grew by an impressive 97% sequentially to reach $5,950 million. Yet accounts receivable skyrocketed by 155% to $2,726 million. This means SanDisk added $1,487 million in unpaid invoices to its balance sheet in just 3 months. To an untrained eye, the $3,615 million in net income looks flawless, but a professional fundamental analysis reveals a hidden tension. The hero of this story is undoubtedly the Datacenter segment, which saw revenue explode by 645% year over year to $1,467 million. This part of the business has transitioned from a small side project into the primary engine of growth for the entire organization. Simultaneously, the Edge segment revenue reached $3,663 million, up 295% from the prior year. This shift allows SanDisk to bypass sluggish retail markets that often drag down hardware stocks during periods of global uncertainty or supply disruptions. This is something you can easily identify in a segment breakdown once you know what to look for and how the numbers interact. But this transformation creates a new concentration risk for your portfolio that must be managed with care. Perhaps the most shocking development on the balance sheet is the emergence of what I call a zero-debt fortress for the company. SanDisk ended the quarter with exactly $0 in long-term debt, down from over $1,829 million at the start of the year. They cleared the books entirely while simultaneously growing their cash and cash equivalents to $3,735 million, which is a 152% increase since June. For your portfolio, a zero-debt balance sheet is the ultimate safety cushion during periods of regional tensions or market volatility. It means the company is no longer beholden to interest rate shifts or banking restrictions that can stifle growth. This is a core principle of value investing. The best companies are those that can fund their own growth without a credit line. With total assets now standing at $17,075 million and shareholders' equity at $13,777 million, SanDisk now has the financial firepower to move aggressively. A strong price-to-book ratio is often a sign of such asset strength when coupled with rising profitability. Management is now betting everything on a new business model, which focuses on multi-year customer engagements rather than short-term spot market sales. They have already signed 5 of these agreements, 2 of which were finalized just after the quarter ended on April 3rd. This strategy aims to stabilize the boom and bust cycle by securing firm financial commitments for volume and pricing over several years. This is a classic maturity move for a standalone company that recently separated from its parent firm on February 21st, 2025, moving away from commodity chaos toward enterprise order. However, notice the paradox in the consumer segment, where revenue actually fell 10% sequentially to $820 million. While every other part of the company is on fire, the legacy business that made SanDisk famous is becoming a shrinking anchor on the total portfolio. In plain terms, the retail shopper is no longer the target for this management team. This divergence highlights a permanent pivot in corporate identity that every investor needs to understand. This is a simple rule, but it is incredibly powerful when looking at mature industries and making long-term predictions. Look at the retained earnings, which swung from an accumulated deficit of $1,784 million last June to a positive $2,746 million today. This proves the company has effectively cleared its historical baggage and is now generating real wealth for shareholders. This change should certainly influence your target price to earnings ratio for the stock. Finally, we must address the massive disconnect between reported profit and actual cash on hand. While net income was $3,615 million, free cash flow came in at $2,993 million for the quarter. Free cash flow is the actual cash left over after a company pays for its operating expenses and capital expenditures like new machinery and property, which totaled $45 million this quarter. That $622 million gap is the friction of scaling a global business at such a violent pace. Growing revenue by 251% year over year requires an immense amount of working capital to keep the gears turning and fulfill orders. Even though they are printing money on the income statement, they must manage their inventory, which stands at $2,238 million, very carefully. Looking forward, management has issued moonshot guidance for the fourth quarter, expecting revenue to hit as high as $8,250 million. They are also forecasting diluted earnings per share as high as $33. Earnings per share is the portion of a company's profit allocated to each outstanding share of common stock, which currently stands at 148 million shares. For your positions, this is a signal of extreme confidence from the executive suite, after a quarter where diluted earnings per share grew from $5.15 to $23.03. The market is now pricing in perfection. SanDisk has successfully pulled off a rare financial transformation in a very short period. Based on the $3,675 million in net income, I predict that SanDisk will initiate a massive share repurchase program in the next 90 days to drive further value. And this is the part that most people never reach. Not because the information is hidden, not because you need a finance degree or a Bloomberg terminal or 20 years of experience on a trading floor, because knowing what happened is only half the equation. The half that actually changes your life, the half that separates the people who watch history repeat itself from the people who see it coming, is understanding why it happened. The mechanism underneath, the incentive that was misaligned, the risk that was mispriced, the assumption that felt safe until it wasn't. That is what we just broke down together. And that framework, that way of reading a situation, does not expire when this video ends. It travels with you. Into the next financial video you scroll past on your phone, into the next conversation about whether now is a good time to buy or sell or wait, into the next headline designed to make you feel something before you have had a chance to think anything. Into the next decision, big or small, where someone is counting on you not knowing what you now know. Here is the truth that every story we cover on this channel keeps pointing back to. Money does not move randomly. Markets do not collapse randomly. Companies do not fail randomly. People do not end up broke randomly. There's always a logic underneath, always a sequence of decisions, incentives, and miscalculations that, when you see them clearly, make the outcome feel almost inevitable. The tragedy is never the collapse itself. The tragedy is that the signals were there the entire time. Visible, readable, understandable, for anyone who knew what to look for. Whether we are talking about a trillion-dollar empire, a housing market on the brink, or the way a single household manages its monthly budget, the laws of gravity remain the same. You cannot build a skyscraper on a foundation of sand, and you cannot build a future on a foundation of financial illiteracy. That is the only edge that actually matters in the long run. Not a hot stock tip, not perfect market timing, just the ability to read the room before everyone else does. It is about shifting your perspective from being a passenger in the global economy to being someone who can actually read the map. Because when you understand the map, the scary headlines lose their power over you. You realize that most of the noise is just that. Noise, designed to keep you reactive rather than proactive. In the world of finance, the most expensive thing you can own is a closed mind. Most people lose money not because they are unlucky, but because they are operating on outdated maps. They are playing a game where the rules changed 10 years ago, but they are still following the old guidebook. By looking at the specific case study we discussed today, you've essentially just updated your software. You've seen how the gears turn behind the curtain. And once you see the machinery, you can never go back to just believing in the magic trick. The path to real wealth isn't paved with complex algorithms. It's paved with the patience to learn and the courage to act on logic when everyone else is acting on emotion. It's about recognizing that every financial disaster and every massive success is just a human story told through numbers. So if this video sharpened something, if it made one concept click that was blurry before, if it gave you one framework you will carry into a real decision, then you already know what to do next. Take that insight and apply it. Don't let it sit as entertainment. Use it as a lens. The next time you see a company skyrocketing or a market dipping, ask yourself, what is the underlying incentive? Who wins if this continues? Who is carrying the risk that no one is talking about? True financial wisdom isn't about knowing everything. It's about knowing how to think about everything. It's about building a mental fortress that protects your capital and your peace of mind. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.